I do believe that this stagflationary crisis is going to emerge this year. The latest numbers on inflation coming from the US and Europe and other advanced economies show that the inflation now is quite sticky, both price and wage inflation. We still have a number of negative aggregate supply shocks. Central banks are in a dilemma because they have to raise rates more to fight inflation. But if they do so, the economy is going to start to contract quite soon. And if they don't, then you could have a de-anchoring of inflation and inflation expectation. So I expect that we're going to have a recession in the US, in Europe, in other advanced economies at the time where inflation is not back to 2%. That's a definition of a stagflation, recession, and inflation well above target.
What probability would you put on a global recession led by the US?
Well, I would say it's certainly more than 50%. Caveat on global recession, US and Europe are going to have an outright economic contraction. Some countries like India are going to do okay. China is going to have some pickup of growth because they're eliminating their zero COVID policy. So there'll be a recession in most advanced economies, maybe with the exception of Japan, and a sharp slowdown of growth in the average emerging market or developing countries.
Inflationary expectations appear to be rising. The 10-year US Treasury yield jumped back over 4% overnight. Do you think the US Fed can get on top of inflation with a 5.1% cash rate, or will it have to go higher, say to 6%?
Well, the markets for now are not pricing in yet 6%. I think that the Fed funds rate will have to be certainly above 6% to achieve a 2% inflation target. But if you raise interest rates to 6%, then you're going to have a real hard landing. Then you'll have also a crash in financial markets. You'll have a severe correction of equity markets. You'll have bond yield going higher. You'll have the credit spreads for borrowing by the private sector rising. So you'll have a severe financial distress. That financial distress is going to make the recession more severe, and a more severe recession by having a contraction of income and output is going to increase the number of defaults by household, businesses, corporates, and even some financial institutions and some governments in poor countries that have serious debt problems. So there will be a kind of a negative feedback between a more severe economic contraction leading to a worse financial crash and a worse financial crash leading to a more severe economic contraction. That's where I believe that eventually the Fed and other central banks are going to wimp out and blink, because faced with increasing interest rates that causes both a hard landing and a financial crash, they're going to decide that they cannot do it. But once that realization occurs, you'll have a de-anchoring of inflation expectation. The wage price spirals are going to become more severe, and inflation is not going to reach the 2% target of central bank. Is going to be somehow higher in the mid-single digits.
So essentially what you're saying is economies and populations are going to have to live with higher inflation. How high?
Well, in the 70s, when they wimped out, we had double-digit inflation. This time around, we might not get to double digits unless there is a major geopolitical shock. In the 70s, you had the war between Israel and the Arab states and the Iranian Revolution that spiked oil prices. I think that markets are underestimating how this year maybe Israel may strike Iran, because Iran is becoming a threshold nuclear state. If that were to occur and the flow of oil out of the Gulf is hampered for a few months, then you could have oil prices going to $200 per barrel. You'll have a shock like in the 70s. But in the 70s, we had this stagflationary shock coming from oil that caused inflation and recession. But that ratio in advanced economies were only 100% of GDP. Today is 420% of GDP in private and public debt. So in this case, if we have those shocks to say oil prices, not only you get inflation, not only you get recession and stagflation, but you get what I call a great stagflationary debt crisis, because with interest rates so high, then debt ratios become unsustainable. Today we have the worst of the 70s in terms of a variety of negative supply shocks, but debt ratios are even worse than after the global financial crisis, when we had the debt problem, but we did not have an inflation problem. So at that time, there was deflation or lowflation. Now we're facing the perfect storm: inflation, recession, stagflation, and a potential debt crisis.
Well, is the very fast reopening of China going to help supply meet demand and curtail inflation, or are there other factors now at play?
There are other factors. Even under zero COVID policy, China was able, by having some production bubbles, to maintain production and exports. So I think the impact of that zero COVID policy on inflation was limited. But now that China is going to open up, if they're going to try to grow, say, 5% this year as opposed to 2-3% last year, their demand for commodities is going to rise, whether it's industrial metal, green metals, oil, natural gas. And that increase in the demand by China, together with bottlenecks in supply, because there has been massive underinvestment into new capacity for energy, green metals, industrial metal, could spike significantly commodity prices this year. Goldman Sachs predicts that commodity prices, not just energy, the entire gamut of them, may increase 43% this year. This is even without a war in the Middle East between Israel and Iran. If that spike in commodity prices occurs, then headline inflation is going to be higher rather than lower. And through second round effects, core inflation is going to go higher rather than lower. That will be one of the reasons why we're going to have higher inflation than what markets expect and eventually hard landing.
What will a stagflationary environment feel like for the general population if it does come to pass?
When there is a recession, incomes fall, wages tend to fall, and people lose jobs and lose income. But when you have a recession with a lowflation or deflation, at least inflation is not eroding your purchasing power. When you have overheating of the economy and inflation is high, maybe prices are rising greater than wages. Like last year, real wages are falling, but at least you have jobs. Stagflation is the worst because loss of jobs, unemployment, weakness of the labor market, and wages are growing less than inflation because you have stagflation. So you have a hit across the board to even those who have a job, to their real wages, because prices are rising more than wages, and some people lose their jobs and their income. So stagflation is the worst of all worlds for workers and those who are having especially labor income and wages.
Given the scenario you're painting, how can investors insulate themselves from inflation beyond, say, the traditional inflation hedge being gold?
Well, normally the price of equities and the price of bonds are negatively correlated. That's why some investment advice says 16 equities are more risky, 14 safer bonds. But that assumes that inflation is low and stable. Risk on, risk off, growth, recession. When equity do well, bonds do poorly, and vice versa. But when inflation is rising, like last year, the discount factor for equity is higher, the long bond yields, equity fall, and a higher bond yield means the price of the bond is lower, so you lose money on your bond as well. Last year, actually, bond yields rose so much that you lost more money on your bonds than you did on risky assets like US and global equity. So the correlation becomes positive. So the traditional investment advice fails, then you have to go to stuff that can hedge against inflation. One, as you suggest, is gold. Another one is inflation index bonds. A third one is short-term bonds whose yield goes higher and you don't have the price impact that you get on long duration bonds. And the fourth one will be sustainable forms of real estate, because real estate is in fixed supply. When there's inflation, tends to be a good hedge against inflation, better than equities. So you have to think about a very different portfolio from the traditional 60 equities, 40 safe bonds. Those safe bonds are not safe when inflation is higher.
And in this environment, what's your outlook for equity markets this year?
They will continue to go down. Last year, they went down because we had inflation and tighter monetary policy. There was a rally in January and February of this year because market expected inflation is going to drop like a stone. Central banks going to stop hiking sooner and they're going to cut rates by the second half of the year. But the recent prints on inflation in US and Europe suggest inflation is going to be persistent. Central banks like the Fed may have to go all the way to 6%. The market is already correcting. bond yields are going back up again. So again, in the last few weeks, you lose money on equities, you lose money on bonds. The correlation is still positive, but bad because the price of both is falling. So you're losing money across the board in your traditional portfolios.
Nouriel Roubini, thank you for making the time.
Pleasure being with you today. Thank you.